If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What's going on, everyone? Welcome to Weekend Recap on the Courtside Financial Podcast, a segment where we bring you a compilation of everything that went down throughout the week from a stories perspective. Before we get into this video, make sure you hit the like button, make sure you hit the subscribe button, and click the notification bell icon so you don't miss out on any content that's coming in the future. But first, let's dive into AI and its potential to replace higher level jobs alongside from the jobs that people are already expecting it to replace. When we talk about AI replacing jobs, there's a broader conversation around upskilling and the ethical implications of AI. Upskilling refers to providing the necessary programs and resources for individuals whose jobs may be taken away by AI advancement. It's crucial to ensure that these advancements benefit society as a whole without causing harm. Now, analysts have identified a few professions that are at risk of being replaced by AI, including accountants, admin and legal assistants, mathematicians, writers, and authors, among others. Even seemingly safe jobs like taxi drivers could be threatened in the future, with companies like Tesla and NIO working on building robo-taxi networks. This raises concerns about the potential impact of AI on the job market, as we've discussed on this channel before. We've seen companies like Synthesia developing AI avatars that can already serve various purposes, such as in sales or talk show host. These advancements, while impressive, also pose a potential threat to job security. Take, for example, a recent campaign by Synthesia featuring David Beckham speaking 9 different languages.
Malaria isn't just any disease. It's the deadliest disease there's ever been.
Se dice que ha matado más de la mitad de la población que ha existido.
بليون مليون تان مريض
وما زالت تقتل طفلا كل دقيقتين.
Mais nous pouvons y mettre fin. Nous savons comment, nous en avons la possibilité.
हमें और अधिक कार्रवाई की जरूरत है.
我们需要让世界领导人关注.
Hivyo tunazindua kampeni ya sauti.
Omwele bawari upin malaria.
Speak up and say, malaria must die.
It showcases the technology's potential for good, but it also highlights the potential for harm it can cause to the job market. Currently, we're in the early stages of AI development, but once AI reaches a point where it can think critically and make decisions swiftly and decisively, it could eliminate the need for many jobs. That's why it's essential to have discussions around upskilling and ensure that the benefits of AI are harnessed responsibly, as Bill Gates said not too long ago, which we discussed on this channel.
OpenAI CEO Sam Altman told me he's a little bit scared about this technology. Are you scared?
We're all scared that a bad guy could grab it.
The White House, the administration, regulators here in the US, do you think they're up to speed?
Not yet.
They're not ready.
Not yet. I mean,
why are they not ready?
You're never going to have every politician understanding it, but how do you build up a capacity for health applications, for education, to review things? The government has a role to play here. You know, they won't be the experts, but they have to be part of that discussion.
Now let's shift gears to our next topic. There have been reports of Amazon allegedly exploring the idea of offering a free or low-cost mobile phone service to its US Prime subscribers. This potential move by Amazon, if it comes to fruition, could have significant implications for the mobile service industry. Amazon is already considered a dominant player in various industries, and entering the mobile service market could further solidify its position. The company is reportedly in negotiations with wireless carriers such as Verizon, T-Mobile, and Dish Network to secure the lowest possible wholesale prices. By offering Prime members wireless plans for a significantly reduced cost or even for free, Amazon aims to enhance customer loyalty among its biggest spending customers. While this move by Amazon has the potential to benefit customers and increase competition in the market, some view Amazon as a monopoly, and its expansion into mobile services could intensify those concerns. There are worries about the impact on competition, data privacy, and security. It's crucial for Amazon to address these concerns and ensure that the data of its users is protected and used responsibly. It's worth noting that these discussions are ongoing and a plan may take several months to launch, even years, or it could even be scrapped altogether. We'll have to wait and see how it unfolds and the potential impact it might have on the mobile service landscape. So you can find the article that I'm talking about today on financialtimes.com. But before we get into the topic of today's video, let's just kind of give an overview of the state of cloud gaming. In 2020, an article from ARK Invest titled "Who Will Become the Netflix of Cloud Gaming" by Nicholas Grouse, the potential for cloud gaming services was discussed. Companies like Amazon, Microsoft, Google, Nvidia, and Sony have been vying for a slice of the cloud gaming market, aiming to capitalize on a trend towards gaming as a service. The article highlighted the shift in the gaming industry from physical discs to digital downloads, leading to hopes of a Netflix-style bundled service for gaming. However, early attempts fell short of expectations due to lack of AAA games, but with more AAA games adopting free-to-play models and monetizing through digital goods and services, the landscape has begun to change. Another important trend mentioned in the article was the rise of cross-platform gaming, pushing the industry towards cloud-based gaming. The allure of cloud-based gaming lies in its ability to provide instant access to games on any connected device without the need for downloads. While cloud gaming is still in the early stages, the involvement of major tech players like Amazon, Microsoft, Google, Nvidia, and Sony hint at the potential for a significant inflection point in the future. Now that we set the stage, let's return to the article from Financial Times discussing the Sony CEO's comments on cloud-based gaming. The CEO raised concerns about the persistent technical problems in cloud-based gaming. Challenges like latency, network stability, and infrastructure-related limitations cast doubts on the feasibility and reliability of the cloud gaming platforms. These concerns remind us that while cloud gaming holds great promise, it's still in its infancy. The technical hurdles that need to be overcome are significant. Latency and network stability in particular are crucial for delivering a seamless gaming experience. And let's not forget the importance of robust infrastructure to support the demands of cloud gaming. However, despite these challenges, it's important to recognize the opportunities that cloud gaming presents. The gaming industry is experiencing rapid growth, and cloud gaming offers a new and convenient way for gamers to access high-quality video games. As more people become interested in gaming, the demand for cloud gaming services is likely to increase. One of the key advantages of cloud gaming is its ability to reach a wider audience. By eliminating the need for expensive gaming hardware such as consoles or high-end PCs, cloud gaming allows companies to attract gamers who may have been previously unable to access these experiences. This expansion of the potential audience can lead to increased revenue and market growth for the cloud gaming providers. Furthermore, cloud gaming has the potential to offer cost savings for both gamers and game developers. Gamers no longer need to invest in expensive hardware to play high-quality games, as the games are processed and rendered in the cloud. This can lower the barrier to entry, making gaming more accessible to a broader audience. Additionally, game developers can potentially reduce the cost of game development by focusing on cloud gaming platforms, which can streamline development and distribution processes. Another significant opportunity lies in the growing popularity of mobile gaming. With cloud gaming, gamers can access high-quality games on their mobile devices, tapping into the ever-expanding market of mobile gamers. Companies that focus on cloud gaming for mobile devices can position themselves to capture a substantial market share and capitalize on the rising demand for mobile gaming experience. It's also worth noting that advancements in cloud computing technology play a vital role in shaping the future of cloud gaming. As cloud computing technology continues to evolve, we can expect better performance, increased reliability, and potentially lower costs for cloud gaming providers. Companies that stay up to date with the latest advancements in cloud computing technology can gain a competitive advantage in the market. So while there are certainly technical challenges facing cloud gaming, it's important to recognize the opportunities that it presents. The gaming industry is growing rapidly, and cloud gaming offers a new and convenient way for gamers to access high-quality games. With the potential for a wider audience, cost savings, the popularity of mobile gaming, and advancements in cloud computing technology, cloud gaming is poised to make a significant impact. However, it's crucial to acknowledge that cloud gaming is still in its early stages, and there's much work to be done to overcome these technical hurdles. As the industry continues to evolve and companies invest in innovation and collaboration, we can expect significant improvements in the feasibility and reliability of cloud gaming platforms. As we wrap up today's discussion, it's clear to see that cloud gaming holds immense potential. It may not be the ultimate gaming paradigm just yet, but it certainly could be in the future. The challenges highlighted by Sony CEO and other industry experts indicate that there's still much work to be done. However, the opportunity for growth and change is certainly undeniable. Alright, so before we get into the topic of this video, let's set the stage. The Chinese government has proactively been promoting the adoption of new energy vehicles in China, and in order to do so, in order to act as a catalyst, they actually have a tax exemption for those who purchase new energy vehicles. That tax exemption is coming to an end. However, China is considering extending it according to a recent article, and that's what we'll be discussing today. So while this news might seem initially positive for NIO, it's important to consider the potential challenges it could pose to NIO due to its pricing structure. Now, let's explore why the potential extension of a new energy vehicle tax exemption might actually pose challenges for NIO. NIO's best-selling model, the ES6, which a new version was recently released, is priced at $52,100 or 368,000 yuan. The challenge arises when the tax exemption is extended, and NIO may not qualify for this tax exemption because their vehicles simply cost too much. The challenge arises when the tax exemption is extended, as it would continue to level the playing field for other electric vehicle manufacturers. With reduced prices across the board, NIO would need to rely on factors beyond just pricing to maintain its competitive edge. Brand reputation, product features, and customer experience become crucial in influencing consumer choices. So what strategies can NIO consider to address the challenge if this tax exemption is extended? NIO should focus on highlighting its strengths and unique value proposition. They should continue to invest in research and development to enhance their vehicle features, improve battery technology, and advance autonomous driving capabilities. By emphasizing their innovative technologies, superior customer service, and overall ownership experience, NIO can differentiate itself in the market and maintain its competitive advantage despite the reduced pricing advantage that others have. They should also concentrate on strengthening their brand identity and marketing efforts to create a distinctive positioning in the mind of consumers. It's crucial for NIO to showcase their commitment to sustainability and environmental consciousness. They can leverage their strong reputation as a pioneer in the Chinese electric vehicle market and emphasize the quality and reliability of their products. Additionally, expanding their charging infrastructure and customer service network will enhance the overall ownership experience and instill confidence in potential buyers. While the potential extension of the NEV tax exemption poses challenges, NIO has the opportunity to solidify its position by focusing on product innovation and brand differentiation. They should strive to create a holistic ownership experience that goes beyond just the initial price advantage. Now, prices are always changing every day, but I do think that the only vehicle that Tesla has that qualifies for this credit is going to be their Model 3. I do think NIO needs a vehicle that competes directly with the Model 3 as well. The ET5, NIO's cheapest car, is $46,295.64 or 328,000 yuan. So that doesn't even meet the qualifier. So anyways, as we wrap up this video, it's important to know that the landscape in the electric vehicle market is ever changing. It's cutthroat, it's competitive, and anybody who is a player in this industry, such as NIO, has to continue to roll with the punches, has to continue to innovate, has to continue to do things to set themselves apart from the competition, because there's so many different new electric vehicle makers. So it's really all about who's going to deliver value to their customers, whether that's from a pricing standpoint, a technology standpoint, just overall value. In our last episode, we delved into why the potential extension of the tax exemption for new electric vehicles in China may not be of any benefit to NIO, but we're actually going to backtrack a little bit today and talk about why that tax exemption could actually be of benefit to NIO in the future, the not so distant future. If you missed our previous episode, I highly recommend you go and check it out. But to summarize, the Chinese government introduced a tax exemption in order to bolster the sales of electric vehicles. This reflects the government's strong commitment to sustainability. Initially, it seemed like a great thing for NIO, right? Well, no. NIO's pricing structure, unfortunately, excludes their customers from being able to take advantage of those tax exemptions. Long story short, their vehicles are just priced too expensively to take advantage of it. The tax credit mentions that vehicles must be priced at 300,000 yuan or beneath that, and NIO just doesn't have any vehicles at that price point or below it. Now you might be wondering, Obi, how could you argue that this might actually benefit NIO if they don't have any vehicles that are able to take advantage of, if they don't have any vehicles priced appropriately to be able to take advantage of this tax exemption? Well, my friends, the key lies in NIO's forward-thinking strategies, such as introducing the sub-brand ALPS in China next year. ALPS, or ALPS, is an exciting venture for NIO, and its significance cannot be overstated. Recently, NIO's president confirmed that ALPS will commence deliveries in 2024, which is right around the corner. This development amplifies the potential impact of the tax exemption extension on NIO's future success. Let's dive deeper into ALPS and its implications. The sub-brand is designed to target the mass market, catering to consumers who may not have the means to purchase NIO's luxury models currently on the market. ALPS will focus more on delivering more affordable electric vehicles with prices ranging from 200,000 to 300,000 yuan, which equates to 29,000 to 44,000 US dollars. This price range aligns perfectly with the requirements for the tax exemption, making ALPS an ideal candidate to benefit from this policy. NIO's president has expressed enthusiasm about ALPS, recognizing its potential to drive significant growth and market expansion. This sub-brand's mission is to provide a wider range of customers with access to high-quality electric vehicles, aligning with NIO's vision of a sustainable and electrified future. While we're discussing NIO's expansion plans, it's worth mentioning their Firefly brand as well. Firefly is NIO's budget-focused brand aimed at delivering mainstream electric vehicles. However, the initial rollout of Firefly is planned for the European market. For the purposes of this discussion, we'll maintain our focus on ALPS and its potential in the Chinese market. Considering these developments, if the Chinese government decides to extend the tax exemption policy, it could be a game changer for NIO. The combination of tax benefits and the introduction of ALPS could propel NIO's market presence, drive sales, and enhance their brand recognition. Picture this: ALPS model hitting the market in 2024, perfectly aligning with the extended tax exemption policy. Chinese consumers seeking affordable electric vehicles are drawn to the ALPS lineup, knowing that their purchases will qualify for tax benefits. This scenario creates a win-win situation for both consumers and NIO, fostering a surge in demand and market share. By leveraging the extension of the tax exemption policy, NIO can establish a strong foothold in the mass market segment, solidifying their position as a leader in the rapidly evolving electric vehicle landscape. The potential impact of ALPS combined with the favorable policy environment cannot be overstated. So while NIO's current pricing structure prevents them from directly benefiting from the tax exemption, the possible extension of policy alongside the imminent launch of ALPS presents an exciting opportunity for NIO to thrive and achieve remarkable success in the Chinese electric vehicle market. So just yesterday, Apple made waves at the Worldwide Developer Conference when they announced their Vision Pro headset. This innovative device marked a significant shift for Apple beyond the iPhone, iPad, and Mac. The Vision Pro has the potential to revolutionize the tech landscape by combining virtual reality, augmented reality, and spatial computing into a single device. However, the hefty price tag of just about $3,500 for the Vision Pro initially drew mixed reactions from the audience. While some were excited about its capabilities, others expressed concerns about affordability and practicality. Apple acknowledged the need to address these concerns by improving cellular connectivity, battery life, and user comfort in the coming years. The true value of the Vision Pro lies in its ability to replace traditional devices like phones and computers. Apple aims to create a device that can communicate better than an iPhone, handle web browsing and productivity tasks more seamlessly than a Mac, and offer an immersive entertainment experience surpassing that of an iPad. As the device evolves, it has the potential to become a true all-in-one solution. However, the widespread adoption may take time. The Vision Pro's interface, which relies on hand, eye, and voice interactions, presents a learning curve for users accustomed to traditional devices. Overcoming this hurdle and making the Vision Pro accessible to a broader audience will be crucial for its long-term success. Meanwhile, shifting our focus to NIO with their first quarter earnings report around the corner, anticipation is running high for the Chinese electric vehicle maker. NIO's revenue for the March quarter is expected to reach $1.69 billion, surpassing their own projections and marking an 8% increase compared to the previous year. However, the market predicts a wider loss of 22 cents per share, up from 18 cents per share as the company continues to face margin pressure. Despite the potential increase in losses, NIO delivered 31,041 EVs during the quarter, showcasing a 20.5% growth from the same period last year. While falling within the lower end of their delivery target range, NIO's consistent growth demonstrates their commitment to the EV market, in my opinion. NIO's Chief Financial Officer Wei Fang has expressed confidence in the company's future prospects. With plans to break even at the group level by 2024, NIO aims to achieve this through robust revenue growth and tighter spending. Their goal of doubling annual sales to 250,000 units highlights their determination to establish long-term profitability. However, even though NIO is very ambitious and has set pretty ambitious goals and made them very public, I don't think that this earnings report is going to be pretty, but at least their sales is moving in the right direction when we zoom out, even if it's moving slowly and lagging behind its peers such as XPeng or Li Auto. Both Apple's Vision Pro and NIO's Q1 earnings report coming out soon offer some good insights into the technology sector and the automotive sector. As Apple continues to refine the Vision Pro, we eagerly await its evolution into an indispensable device. NIO's first quarter earnings report will provide critical insights into their financials, and while it appears that it's going to be negative and the losses are going to widen, their strategic focus on revenue expansion and all the opportunity ahead provides hope for investors. And I'm aware that it does come with its risk, but I'm a fan of the company. I'm not telling anybody else to invest in the company. I think everyone should do their own research before making investment decisions. Disclaimer. Alright, so I'm just going to get straight into the video. In this video, I just want to give some real candid thoughts on NIO. Obviously, and this is going to be an opinion piece, of course, but obviously there's a lot of negativity around the stock price right now. I've tried to convert this channel into a channel where we just mostly speak on the news because or try to get even too high on the highs or too low on the lows, for lack of a better term. A lot of investors have been very upset with NIO. You know, they're spending money on a lot of things. They're burning a lot of cash. To keep it quite frank, they're spending a lot of money on a lot of things. They're burning a lot of cash. Their deliveries are lacking behind their competitors such as XPeng or Li Auto. They're not up there with the BYDs or the Teslas, who are at the top of the new energy vehicle market right now. And so you guys are all asking me, hey, what's your opinion on the stock? What's your opinion on the company from a financial perspective? To that I say price does not equal value. NIO for me is a long-term play, and I feel the exact same way I felt when I posted my first NIO video 3 years ago. You guys even go check out that video, go read the comments at that time, and go see what people were saying at that time. But I feel the exact same way, right? We have a company that is doing big things, and I feel like at the time a lot of people missed out on the opportunity to invest in a company like Tesla because they value Tesla strictly as a car company and not as a technology company. At its core, that's what I view NIO as, still not a car company, as a technology company. My thoughts have not changed at all, and obviously cycles are going to repeat themselves. Markets are cyclic. At times companies that are growing can be cyclic as well. They go through these big volatile swings. Sometimes everybody who invested in the company is extremely happy, and then it gets to a point where they're, you know, extremely negative, extremely pessimistic. Me, I try to stay leveled out. What am I doing with the company right now? I'm consistently buying every other week, and I'm aware that it does come with its risk, but I'm a fan of the company. I'm not telling anybody else to invest in the company. I think everyone should do their own research before making investment decisions. Disclaimer. But anyways, overall, at a high level, my opinion has not changed. Still bullish on this company. Still obviously talking about this company all the time. Still kind of centering the discussions around it, even though we have started venturing out and posting more tech news as well, just trying to keep people informed here. So with that being said, let's finally get into the video. you guys watch this video, let me know what you think. What's going on, everyone? Welcome back to Courtside Financial. This is a brand new channel, so if you're new here and you want to be a part of it, make sure you hit that subscribe button, make sure you hit the like button. Those things really do help out the channel, and also I want to know what your thoughts are on NIO in the comments below. So if you've been keeping up with NIO stock in any way, shape, or form, you know that this stock has had a lot of volatility, and it's pretty much been a wild ride for shareholders and investors, as well as NIO, the company itself. My personal experience with NIO, I bought in last May, May 15th, which was, I believe my cost average was somewhere in the 470s range. And I continued to contribute to that position and continue averaging down through the lows, through the gains, just dollar cost averaging the stock. And when the stock was truly beaten up in like the twos, the ones, that's when I contributed more than I usually do. And with that being said, I was able to bring my cost basis down to, I believe, about $2.20. And I sold the stock at $4.70 in January, which left me with a huge profit in NIO stock. At that time, what I decided to do was stay on the sidelines and just kind of watch NIO stock. And eventually, a couple weeks ago, I bought in NIO at $3 and I sold my position at about $3.80, locking in profits. And now I'm here and I'm back to get in long term, and I'm gonna explain to you guys my bullish case for NIO. NIO is currently trading at $4.04 at this time. It is 12:39 p.m. Eastern time, and what that means is that NIO stock is up about 18% for the past week. Now, there's a lot of reasons why the stock has been kind of climbing within this short time frame. The biggest reason right now is because the Bank of America analysts upgraded the stock by 47%. Analysts are just starting to catch on, and I believe that the stock is truly undervalued if you believe in the company and you believe in its long-term value. Now I'm going to talk about why I believe in the company. As we all know, the demand for electric vehicles is certainly going to increase over time. The NIO story can kind of be thought of as the Tesla story. Let's think about the cost of electric batteries. The cost to produce an electric car battery has dropped 87% from 2010 to 2019, from $1,100 per kilowatt hour to $156 per kilowatt hour. That's a huge change. With that, I believe that we're going to see a lot more car manufacturers producing electric cars because the cost has cut down so much. And that's also going to have an effect on the consumer side, because since the cost is lessening, that means that they will be more affordable for consumers. Not only is the cost to produce electric batteries consistently dropping and will probably continue to drop over time, now you also have to think about the other costs that are there when it comes to having a car. A lot of the big costs that are associated with cars are maintenance. When you think about internal combustion engines, there's a lot of problems that come with them. There's a lot of pieces and parts that are oftentimes breaking down and need repair and need service. When you think about electric vehicles, they're a lot easier to manufacture. There's less parts, there's less complications, meaning that there's less problems. Now, in terms of NIO and Tesla, it's pretty much like strapping a battery onto a frame as opposed to putting all these parts together. So that makes it more efficient because there's less things that are going to break down, there's less complications to be worried about, and there's less expense as cost of ownership. Now, you also have to think about how much money that you're going to save at the pump. Electric vehicles are saving you a ton of money at the pump as opposed to internal combustion engine vehicles, which gas prices are pretty cheap right now, but we don't expect them to stay that way. They will ramp up, and like I said, the battery cost is going down. The overall manufacturing costs are going down for electric cars, and not only that, but there have been times and situations when the government has offered subsidies or tax credits to those who own electric vehicles, not especially in China. So it's going to be this whole wave of disruption that over time eventually pushes everyone out of this market inefficiency of internal combustion engine cars to the more efficient thing to do, which is electric vehicles. A lot of the mistakes that people are making when it comes to talking about Tesla and talking about NIO is that people think that they can't mutually exist, which is completely incorrect. I expect that Tesla opening up their China factory will actually spur demand for NIO vehicles, because NIO is a competitor that comes in at cheaper price points than NIO, and then also the Chinese will have a sense of nationalism when it comes to supporting NIO, since it is a Chinese EV manufacturer as opposed to Tesla. And then the other thing is that the government is behind NIO. So first I want to take a look at the Model X, which is Tesla's flagship SUV at the time. And then I want to take a look at the ES6, which is a smaller version of NIO's ES8. So when you look at the Model X, if you wanted to get the cheapest version that Tesla has to offer, that would be their long range plus. With that, you're going to get 351 miles of range on a full charge. You're going to be able to do 155 miles per hour top speed, and you're going to be able to go 0 to 60 in 4.4 seconds. Now I really want to talk about that 0 to 60 in 4.4 seconds. When you think about the typical consumer, the typical buyers of SUVs, they're not purchasing SUVs to kind of drive like it's NASCAR or anything, right? They're purchasing SUVs for the functionality and utility of it, as opposed to getting a smaller vehicle like a sedan or a coupe. They're purchasing it for practicality. It's a lot easier for families to have an SUV than to have a car. So I don't think that the 4.4 0 to 60 matters too much to that typical consumer of an SUV. Now, looking at the NIO ES6, what you can see here is that you're going to get 610 kilometers of range, which equates to 379 miles of range. 0 to 60 time, it actually says 0 to 100 kilometers of 4.7 seconds, which equates to 62 miles per hour. So from 0 to 62 miles in 4.7 seconds. So obviously this is slower than the Tesla, but like I said, when you think about the typical consumer of an SUV, no one is buying these to kind of go drive on the Autobahn per se and speed. People are buying these for practicality and utility. There are three options when it comes to purchasing an ES6. You have your signature edition, you have your performance version, and you have your sporty version. Let's just go with the signature edition and the performance version to keep things fair. If you went with the sporty version, which is a little bit slower, that would be $49,935. If you went with the performance version, that would be $55,514. So these are pretty much coming in at a way cheaper price than the Tesla Model X. So and like I said, the Tesla Model X from a performance standpoint is a better car, but not when it comes to range. And when you're buying an SUV, you're buying it for practicality. You're not buying it to drive as fast as you can. So what would you rather have? Would you rather be able to go a little bit faster in your SUV, or would you rather be able to have longer range and be able to recharge less? Now, I do think that Tesla's range is going to increase in the future, and I also think NIO's range is going to increase in the future. And I did say that Tesla is the bigger name. These two companies can coexist, and Tesla doing great things in China will ultimately drive demand for NIO. Now, why do I believe Tesla can drive demand for NIO. The NIO ES6 ranked number 1 on Auto Home's latest vehicle quality report, above names like the Lexus EX, the Ford Focus, the Mazda CX-4, and the Audi Q5. For the vehicle to rank number 1, this is proof that NIO is making a good product. And personally, not only is the product good, but I also think that the product looks good. We know that reliability is a huge driver of consumer purchase intentions and consumer demand in the automotive vehicle industry. So when you're making a reliable vehicle, I know for me personally, that's the first thing that I look for when it comes to purchasing a car. And I think this will make sense to a lot of other people. Who wants to keep on going to the mechanic? Who wants to worry about unwarranted vehicle expenses? Nobody. So this is a very big deal for NIO. They're making a solid product, and now the challenge becomes the business. What do I think NIO has to do? So NIO has a market cap of $4.2 billion, and their annualized revenue sits somewhere around $1.5 billion. It's important to understand that the automotive industry is capital intensive. It requires large capital up front to remain sustainable. And the problem with NIO is they've been burning cash since they IPO'd. I was not one of the people to buy NIO at the IPO price. Like I said, I bought it last year at May because I'm just not a buyer of IPO. So with NIO's earnings report being tomorrow, Thursday, May 28th, what we want to see is growth. What we want to see is that they actually beat the earnings per share's estimate of negative 26 cents per share. I think that they'll beat that, but who knows? No one knows. NIO, if they want to survive, they're going to have to be able to scale and ramp up sales and create more demand. I don't think the product is the issue. I think it's all just going to be based on that. One of the things to note is that when NIO reported their Q1 sales, they actually grew by 13.1%. Now, if we look at Ford sales in China for Q1, they decreased by negative 44.9%. If we look at Volkswagen, they decreased by negative 52.7%. If we look at GM's Q1 vehicle sales, they dropped by 43%. Much like Tesla, this is pretty much looking like a lot of disruption is going to come forth in the auto industry, and it's going to favor those who are in positions to take advantage of it. I do want to talk about Tesla and NIO, and again, why they're in two completely separate places. NIO is seeking funding to survive. Tesla is seeking funding because they are supply constrained. I believe there's going to be a lot of demand for Teslas, but they aren't able to produce enough. That's why they gathered funding at the beginning of the year. NIO actually gathered funding to survive, and the government has showed us that they are behind NIO, and they are playing for keeps when it comes to electric vehicles. China might be the biggest power in electric vehicles. They have the biggest market for electric vehicles, and they're taking this very seriously. The government has given NIO $981 million, almost $1 billion in funding for a 24.1% stake in NIO, and the agreement to move NIO's operations to Hefei. Now, another thing that I want to hear in the earnings call is, how is this agreement going to affect U.S. shareholders with giving them access to that capital? This was one of the stipulations, but I do think the capital was much needed. It's going to give NIO a little bit of energy to do the things that they want to do and do the things that they need to do to stay afloat and continue to grow and continue to survive. I'm so bullish on NIO because the automotive industry is continuing to change. They are one of the players that are being extremely aggressive when it comes to ramping up sale, when it comes to trying to ramp up sales. and trying to gain market share, and I believe that the demand for their products will be spurred by the demand for Tesla, who is at another level currently. My thoughts on the share price being under $5, if they can survive and they can continue to grow their numbers, then NIO is very undervalued at these prices. Now, there are a lot of risks. I don't think that the Chinese government will let this company go bankrupt. There's a sense of nationalism. The Chinese want to be big in the automotive game. I believe that this is a company that can eventually go on for global expansion. But with all that being said, this is a speculative stock, and there's huge upside, believe that, but also believe that there's huge risk that come with investing in this equity. Whatever happens in the earnings call, whatever is said, could kind of be scary for U.S. investors, because NIO, Luckin Coffee was a case study of pretty much Chinese stocks that scared a lot of people away from investing in China. Now, with them taking this deal from the government, it's going to be interesting to see how that plays out, because a lot of these companies use shell companies in the Cayman Islands in order to be able to trade on the North American exchange. And with that, there isn't a lot of protection for us, not the same protections that we have when we invest in U.S. businesses. You think about how many times shareholders have actually filed lawsuits against particular companies as part of their protections as shareholders. Now, I don't think NIO, being what it could be for China, being the could possibly in the future be the staple of the automotive industry over there, would partake in such unethical actions when it comes to their books and their accounting practices. Good news is that the government is now inside of NIO, so will they let them fail is the question that we all need to ask ourselves. Not only that, but NIO has Intel, one of America's powerhouses of technology, as a partner to help squash any of the anti-Chinese rhetoric that's floating around, especially right now with a lot of talk about Chinese companies being delisted. Do I think NIO will be delisted? No, I think that there's going to be NIO stock will have its day, but that's just my opinion. None of this is investment advice. I look forward to seeing what happens after earnings and how that's going to affect the share price, but I'm not someone who's looking to swing trade NIO anymore. I've already made 2 profitable swing trades on it. I think it's been beaten up pretty badly in the past 2 years, and now I just want to figure out when it's going to be the right time for me to lock in a position and hold for the long term. I do want to understand more about the funding deal and how that's going to affect us first. And also, I want people to think about how many shares of the company Lee Bin owns. He is the CEO of NIO. My guess is that he would want to remain a billionaire as long as possible. So for him, it's in his best interest, and not only his best interest, but also the shareholders' interest, to continue to make sure that these shares continue to rise over the long term. In an interview that he did last year, he said that a lot of American investors are not seeing the long-term value of NIO, and that's kind of what made me do a deep dive on this company and look into it a lot more and be able to form my own opinion and ignore whatever else you see in the news. It's pretty clear that NIO is facing financial challenges, but the company's ability to diversify revenue streams and adapt to changing market conditions will be crucial for its success. Alright, so like I said, NIO has finally released their highly anticipated Q1 earnings report. And so we're just going to dive right in. We're going to get very objective. And I might even sprinkle in a little bit of opinion as well, because I do want to know what you guys think and I want you guys to know what I think. While NIO's recent performance isn't the most impressive, it certainly is a good piece of news here because a lot of people were expecting earnings to be worse than what it is, and the stock has reacted positively to this. It's important to consider the potential risk and challenges though. The electric vehicle market is highly competitive with numerous players vying for market share. Factors such as government policies, supply chain disruptions, and changing consumer preferences can impact NIO's performance and market dynamics. Therefore, it's crucial for investors and enthusiasts like myself to stay informed, conduct thorough research, and carefully assess the risk associated with investing in electric vehicles. Their revenue surge, improved gross margin, and progress towards profitability indicate a company that is making significant strides in the electric vehicle market. In terms of revenues, NIO reported total revenues of $1.55 billion for Q1 2023. This marks a 7.7% increase compared to the same period last year, but a significant decline of 33.5% from the previous quarter. Vehicle sales revenue amounted to $1.34 billion, with a slight decrease of 0.2% from Q1 2022, and a significant drop of 37.5% from the previous quarter. The decline in vehicle sales can be attributed to a lower average selling price due to increased deliveries of the ET5 and the 75 kilowatt-hour standard range battery pack model. However, this is partially offset by an increase in delivery volume. Moving on to other sales, they experienced remarkable growth, reaching $211.4 million, reflecting a significant increase of 117.8% compared to the first quarter of 2022, and an 11.3% increase from the fourth quarter of 2022. The growth in other sales was driven by increased sales of accessories, provision of repair and maintenance services, auto financing services, sales of used cars, and power solutions. It's clear that NIO's effort to expand its user base is paying off. Now let's take a closer look at the cost of sales and gross margin. The cost of sales for Q1 2023 amounted to $1.53 billion, representing a 24.2% increase from the same period last year, but a significant decrease of 31.9% from the previous quarter. Gross profit, however, stood at $23.6 million, marking a substantial decrease of 88.8% from Q1 2022 and a 73.9% decrease from the previous quarter. This decline in gross margin was primarily due to a decrease in vehicle margin. The vehicle margin for Q1 2023 was 5.1%, significantly lower than 18.1% reported in Q1 2022 and the 6.8% in the previous quarter. The change in product mix and increased battery cost per unit played a role in driving down the gross margin. Turning our attention to operating expenses, NIO's R&D expenses were $447.8 million, representing a substantial increase of 74.6% compared to the first quarter of 2022. However, there was a decrease of 22.7% from the previous quarter. Selling, general, and administrative expenses amounted to $356.2 million, reflecting a 21.4% increase from Q1 2022 and a 30.7% decrease from the previous quarter. Now let's address the net loss and the business outlook for the second quarter of 2023. NIO reported a net loss of $690.1 million for Q1 2023. This represents a significant increase of 165.9% from the same period last year. However, there was a decrease of 18.1% from the previous quarter. Looking ahead, NIO expects vehicle deliveries for Q2 2023 to be between 23,000 and 25,000 vehicles, reflecting a decrease of approximately 8.2 to 0.2% compared to the same quarter of 2022. Total revenues for the second quarter are projected to be between $1.27 billion and $1.36 billion, representing a decrease of approximately 15.1% to 9% from Q2 2022. It's pretty clear that NIO is facing financial challenges, but the company's ability to diversify revenue streams and adapt to changing market conditions will be crucial for its success. That's going to be it for this episode of Week in Recap for the Courtside Financial Podcast. If you found any of this information valuable, make sure you hit the like button, make sure you hit the subscribe button, and definitely leave a comment down below. Genuinely interested in hearing what you guys think about these new this new style of videos that we're doing. Anyways, that's going to be it. I'll catch you guys next time.